Just a little bit.
Hello, everybody. Thank you for joining us. We are joined by Dr. Adamians and Dr. Rhodes from Academic Market Insights. If you don't know, they tend to go into the nuts and bolts of finance and what that looks like from an academic perspective, whereas we kind of tend to do a 10,000-foot view of mental health. And you might be asking yourself, why are we doing a cross promotional podcast? And other than the obvious reason of, hey, we would love to broaden both of our audiences, it's that really mental health and finance are very closely related on both ends, in that finance affects mental health, but also mental health deeply affects finance. And understanding the 10,000-foot view as like a layman, as well as a little bit of the nuts and bolts as somebody who really knows about it, can make a huge difference in your life and personal finances. So, and that's what we'll be talking about today, is behavioral finance. So without anything further, I'll kick it over to Doctors Rhodes and Damietz to start our talk.
So I'm going to jump over Dr. Rhodes. Russell, I'm going to talk over you before you even have a chance. I want to highlight some of Russell's research and one of the reasons why we were so thrilled and just thankful to be included in this podcast with you guys. Russell has spent quite a bit of his life dedicated to this idea of what's called behavioral finance. It's the idea of how do we make decisions. One of the underlying, and we're going to talk about some of these things. I am giving away a little bit of our secret sauce here, but we're going to talk about what it means to be a rational investor. And Russell has spent quite a bit of his time talking about why we aren't rational investors. In fact, there's a index called the volatility index, and it's often referred to as the fear index because it measures the implied volatility or uncertainty in the markets at this moment. And Russell worked for the Chicago Board Options Exchange and literally wrote the book on VIX. So we're looking at somebody who is an expert in this field, and this is definitely a passion for Russell, but it's such an important topic because we feel when we start to make trades, right? We think about our gains versus our losses. And I mean, you might have ever thought about like why a loss hurts so much more than a gain of an equal magnitude, right? Like those losses sting. And Russell has spent his life thinking about these things. So it is a real treat to be on here. We're really thankful for it, and we're happy to be exploring this aspect. We also are going to be thinking about how some of these, as an academic framework, how it doesn't necessarily line up with reality. And this is something that's also important to our site because we spend most of our time talking about how the textbook says one thing and then the market does something else, or market behavior is something else. So again, just delighted to be here. And I hope that was enough talking over you, Russell.
That's kind of an inside joke between the two of us. I have a very difficult time not talking over people periodically. So she made the jump there ahead of me. I wanted to start out with some of the things that we talk about in the classroom when we're introducing students to investments. On the next slide, I actually show the capital asset pricing model. You guys can go ahead. There should be a picture that fills in there as well, hopefully. But if not, this is basically the formula. It's the expected return from a stock. And this is what we teach, is equal to a risk-free rate plus the beta minus what we refer to as the market risk premium. And that's what that expected market return minus risk-free is there. Now, in the textbook.
Wait. So I'm going to jump over you. And the risk, we call it a risk premium because it is the premium over the risk-free rate.
Right, exactly. It's the risk premium. The idea there is If you don't think stocks are going to go up at all, and stocks are your only alternative, you would put money into cash, and basically you would earn about the risk-free rate. So the risk premium, the concept there is how much how much do you expect to be compensated for taking on the extra risk associated with owning stocks. Now, there's a professor from one of the Ivy League schools that sends out a survey to about 300 academics every year. And the question is, what do you think the proper risk premium should be for next year? I used to participate in that, and they kicked me out because one year I said negative 20%. But and you would never see it, but we were at all time, and I actually might say that going into 2026. But
Yeah.
Everybody always says 7, 8, 9% on a consistent basis. The average from the survey, which I don't get the survey back anymore because they kicked me out of it, but it was always about 8%, regardless of what was going on in the real world. So this expected return using the capital asset pricing model, it does have some issues. And yep.
So I did want to ask a question about that, this is one of the things that really fascinates me about the market and mental health is like this idea of groupthink. And like I feel like we definitely see it in the market all the time, but we don't talk about it at all. But like there's been certain holdings or certain situations where I'm just like literally everything is saying that this is not an appropriate valuation that I can say, or this is not whatever. But even all the articles that I'll read and everything is just supporting what the market is already doing. And that always blows my mind because it feels like to me, as a private investor, that at any given time, roughly 60% of the market, maybe more, is just how people are feeling
Oh yeah.
about any
Definitely.
given position.
Oh,
Russell,
yeah.
I'm going to jump in.
Mhm.
So we're going to talk about what's called the greater fool theory a little bit later, because I think that this definitely plays into that. Also, also when we think about the emotional sentiment, I actually had a good point. But this idea is that we don't necessarily behave like we're supposed to, right? Oh, and the group think, that's what I wanted to talk about. The group think is something that's interesting, that's kind of exploding right now at the moment. So I worked for a company called Peak Six, and about 20 years ago, we initiated something, a group think algorithm. And the idea was if you really believe that your group of employees, we were about 400 at the time, really are smarter than the average, we should be able to come up with probabilities of different things happening. And we're seeing that now in the prediction markets. And so some of these prediction markets are starting to embed exactly what you're talking about. So with this idea that I'm a little bit of a contrarian, you're not alone. There just hasn't been necessarily a voice or a place for them. And one of the things that has also happened, particularly with contrarians, those are usually the people who go short, because it's a lot easier to write something positive about a company and say, yes, we should invest into this company for X, Y, and Z. It's a lot harder to come out and say, no, we should sell this short because of A, B, and C. That story is a harder thing to sell in the media, and that makes people uncomfortable. And I don't think we'll talk about this, but one of the things that we like to talk about when we talk about introduction to options right now is we've got this idea that, and I think it was Russell, correct me if I'm wrong, it was 73 that the options started trading for call options in 1976 when put options were allowed. And a put option, you generate a rate of return when the company goes down in value. And that was deemed un-American. So we've got this idea that we can't say negative things about companies. It makes us uncomfortable. We don't participate in those conversations. And sometimes we put on those shiny glasses, those rosy glasses, and ignore all of the issues that a company's having, which is one of the reasons why short sellers often are right, because they have to do that much more homework to overcome some of those challenges.
You
So,
covered like half of the thing there, Laura. So you jumped
Okay.
everything. I got to jump. I got to figure out how to loop back. Well, first off, on the group thing, and this is something that I'm kind of formulating now. But you've got all of these trader groups
Mhm.
that it's almost like you've got guys that like to brag about how much money they've lost, and I don't ever remember seeing that. And I feel like that's a new behavior that we've got to do a little work on. But I do want to talk, I want to loop back to the academic stuff before we get into
Yep.
the behavioral stuff just a little bit, because it does kind of tee things up there. The problem with that capital asset pricing model, beyond nobody using a real world estimate of what you think the market's going to do the next year in it, is there's this belief that we're all rational. We're not rational. I get in trouble, but I've decided it's too good of an example to not continue to use. But with undergrads, I use dating examples. I know I was a very irrational person when I was in college, especially when somebody ran off to Mardi Gras with another fella. I'll equate that to a giant personal volatility event. We don't react very rationally. We all react differently to events like that. Different types of traders have different risk tolerances. We also have different time frames.
Wait. Sorry, I want to go back to the rational. So Russell and I have very different examples. I don't know if anybody can see this. So my example is Michael Jordan. He is not a rational investor. And the reason why, and I don't know Michael Jordan, just for clarification, I do not know him personally, but he is, I think, has over $3.5 billion. He makes an annual $400 million in passive income from Nike every year. He is not necessarily looking to maximize returns. Russell, what do you think he's trying to do?
I think he's just trying to live his life and have fun.
I think so too. But he's also, he's,
Yeah.
preserving wealth. He just doesn't want to lose the money, which is very different than being rational, where we're trying to maximize returns and minimize risk.
Yeah. So, and I would say that he,
can I jump in with a quick personal story? I'm sorry,
Yep.
you guys are going to
go ahead. Please.
We're always meandering all over the place here.
Yeah.
But Dr. A taught me finance in undergrad, and I remember learning the CAPM model, and one of the key assumptions is that investors are rational, and it bugged me so much that it made me irrational, because I was like, that is a gigantic assumption to make and a huge leap to make, because you can ask anybody. No, we're not. Nobody's rational all the time anyway. And I remember very vividly, there was like a multiple choice test that you gave me or gave us, and I think she might remember it too. But like it was entirely on CAPM and rational investing, and there was like so limited choices because it's multiple choice, and I scrawled in the margins like this is, I don't agree with this 100% because this is because of this and this, and that's a really, like, that doesn't make sense. So I took like 20 minutes to take the test, and then I took the remaining 40 minutes to just voice my objections to this model.
Well, and it's funny, I can tell you this now, Aaron. These are old CFA questions that you're answering.
Yeah, we actually use these questions for a lot of our classes. So, and they're kind of, half academic, half professional. So there's some unrealistic things going on with CFA material as well. And I don't think they emphasize behavioral as much as they possibly should, especially because a big emphasis of the CFA is managers are supposed to assess, the risky, people's risk tolerance, and then back into what you should do investment wise for them.
Right.
So, we talk about, we do 95% of the test on how to pick investments, et cetera, and then only 5% talks about the behavioral stuff. It probably should be a bigger emphasis on that, especially for people that are going to continue to be client facing, for sure.
Right.
So, what else on the assumptions before we move forward? Just we're all using identical inputs. We all have a different forecast as to what we're expecting. I've got about 10 to 15 years left until I hit retirement. Maybe some of my exceptional students will be able to retire in 10 to 15 years, but I doubt it. So their time frame is very different than my time frame is. Assuming that all relevant information is publicly available, we know for a fact. I did a study recently on drug trials, because drug trials are the kind of information that tends to leak out over time. And I showed that before a successful announcement, the stocks and the options already reflected something positive was going on, but there was actually follow through as well. So, people that are getting ahead of those those positive drug trial announcements, they did have access to information, and I'm not going to say inside information, but information maybe that other people do not have access to. You guys keep telling me how to forward slides, and I don't see how to do it, so somebody else needs to forward a slide.
So I want to make also a comment about the relevant information. So last year was a banner year, right? So the average return for the S&P 500 over the last 10 to 15 years has been around 11%. And depending on how you estimate it, we were looking at returns between 16 and 18%. So last year, because you have those two data points, it sounds like a brilliant year for S&P, right? Yeah. Anybody not happy with that, right? And the reason why we're happy with that is because we had both of those pieces of information. If you don't have the 11% and understanding that that's the average, then you get a return of 16% or 17%, and you don't know if you've really done well or not. You don't know if you should be happy. You don't have anything to guide it with. Now, if I told you that in the same time period, gold had a 65% rate of return, how do we feel about now our 16% return on the S&P? Doesn't feel as good, right? So part of having that information is really understanding where some of this information is coming from, but also being able to compare it to other information. And that's not necessarily something that we all have access to, or even think to have access to.
No, not at all. So
that's
Yep, go ahead, Aaron.
That's an interesting point. I'm sorry. I'm going to keep interrupting as I have thoughts. So sorry, but that's an interesting point to relate it to mental health, because in mental health, it's always like comparison is not a great thing. You always want to look internally, entirely based off of what's happening with yourself. But in finance, comparison is essential. It really, that's how you judge success or failure. And I wonder, from like the individuals investing, doing institutional investing, if that mentality, because there's a ton of studies of your job affects the way that your brain works over time, but I wonder if that mentality of needing to compare everything leads to mental health issues, or can lead to mental health issues, as they're comparing maybe things that they shouldn't be comparing, if that makes any sense.
And you have access to the information overload that we deal with now. I started my career before electronic trading was really a thing. And really before, we would get some decent headlines off of Bloomberg, but not the amount of information that we have now. So, I have undergrads asking me about how can they achieve private equity returns, because they see great private equity returns. So that FOMO thing, that fear of missing out, that CNBC, I think, instills into our brains,
Yeah.
I see that carrying over an awful lot into some behavioral anomalies, and some that I think haven't really been studied yet, because the ease of access to information, it's overwhelming. But it also, you're never going to be, you're going to be like Ricky Bobby. You're never going to be first. You're always, at best, you're going to be second, and second is the first loser. It's going to be very rare that you're going to top something else that you hear somebody bragging about, etc. And maybe that's why people like to, if you can't brag about your gains, maybe you like to brag about your losses. I still haven't fully gotten a handle on that one at all.
Well, and I'd like to comment. Russell sent me a video, and I did share it with my sister over the weekend. Tasty Trade put out a video on what it's like to date a trader, and it's funny. I do not want to give anything away, but my sister's comment, because she's dated a couple of traders, that is spot on. And it's this idea of you can't get too married to an idea, so you quickly push it away and then you want it back, and then it's this back and forth. And I believe, just based on personal experience of being in this field, that's how a lot of traders behave. They get into a trade, it starts to go, the trade goes well, so they're very excited about it. Then the trade starts to go against them, then they want to push it away. And there's this idea, and we'll talk a little bit later about this in the deck, but when you hold on to a loss for too long, or you don't sell too quickly. So if you are starting to rise in the price and the trade is going in your favor, there's a point when you should sell to cap the returns. And a lot of traders will become emotionally invested into their trades on top of it. And I believe that that's how they live quite a bit of their lives. It's this emotional ride that they take, and it's almost as if they can't take themselves off the ride. They have to ride it for everything that they do.
And there's an opposite to that as well. If you've ever heard the trader term, a stock is in the penalty box, that typically means we've never been able to get a handle on it. So I worked at a hedge fund where we would do that. It's like, we felt like we had a good handle on fundamentals. We also would use technical analysis for our entries. But there were certain stocks that we just never felt like it's like, why fight when there are a couple thousand other stocks we can deal with? So it goes to fear of missing out. You got to be involved in the stock that everybody's involved in and bragging about. But at the same time, you may avoid a stock that you've had a bad experience with in the past. Again, when I loop around to my dating experiences, if there's some characteristics of a bad ex that you pick up on a first date, you want to move on to that. They're going to penalty box that poor person that's on the date with you.
Or at least you should.
Yeah, at least you should. Yeah. Again, we're not rational, are we?
No.
So CAPM, I did want to just give it a couple of, it's not completely worthless. It does show that we should diversify. When we say systematic risk, and this is something that if you took investments from me and you don't go away with this, that means you never came to class, because I bring it up so much. But the real risk, what really moves the price of stocks, and it's like 70 to 75% of what happens to the price of a stock over a long period of time is what happened to the market. And then another 10 or 15% may be what industry they're in. And then 10% is just management. So it really comes down to, the systematic risk is the one that matters. And I'm not talking about for short-term traders. I'm talking about for long-term investors. Because if you pick the best company in the world right now, and the stock market sells off 20 or 25% this week on something, that stock's going to go down regardless of what's going on fundamentally with the company. But CAPM, it does give us a good prediction of long-term returns, but over the short term, CAPM is not a very good predictor of like next year's returns for a stock. And on the next slide, we're going to get into efficient market hypothesis, which is something that Dr. Ademiak and I do not agree on too much. I don't believe in it. I've seen too many people that have done particularly well with the financial markets. But these are the assumptions. And one of them already came up, that there's no greater fool. I know for a fact that there are greater fools. I've been in the trading industry too long. There are people who And when we get into some of the heuristics, it's what makes them a greater fool. They think they're smarter than everybody else in the room. If they hear information that counters their position that maybe they should take into account, they don't. They get
So,
married to a position.
so just for everybody else, what is, in layman's terms, what is the efficient market hypothesis stating?
Sure. And there are three kind of levels of it, but the idea behind the efficient market hypothesis is that the market is fully efficient. It basically reflects all information that's relevant to the stock price, depending on the level. But it really does come down to over a long period of time, regardless of how hard you work, you really should not be able to outperform the market. And I've seen too many people do too well with the markets to believe that with work, that if you do put the effort in, that you can't outperform. I think there are certain things that you can do that lead to outperformance. But like CAPM, and there's just like CAPM, the efficient market hypothesis just has some assumptions that are not necessarily realistic. And the no asset bubbles is basically saying that according to the efficient market hypothesis, stocks are always fairly valued, which we know that's not true. And then you never need to hedge. And I made my living in the option industry, so it'd be very upsetting if nobody hedged. But if the market is efficient, there's no reason to use hedging tools as well. So sorry, Marissa, I jumped on you there, but I was on a roll.
So, Aaron, when we talked about this in class, I probably said, this is just garbage. One of the reasons why we talk about it is because we do assume that markets are efficient, and we can prove in the long run that the mean or the return on assets is going to be zero. And again, this is in the long run. But this is also a theory put out by the University of Chicago. There are some Nobel Prize winners at the University of Chicago who put forward this theory. And I know in class with you, I would always make the joke that if a University of Chicago student and an Illinois Institute of Technology student were walking side by side, and there was a $20 bill on the floor, the University of Chicago student would say, the markets are efficient, therefore this is just an imaginary thing, versus the Illinois Institute of Technology student would happily scoop up the 20 and put it in their pocket. Because under this assumption, you could never make those short-term gains. You could never outperform the market. And it's one of those things that, we really don't agree with, because we've seen it in the markets where people can make excess return.
So, I feel like
yeah, go ahead.
My biggest issue with this, because I do remember learning this, and this was another one where I scrawled in the margins. It might have been the same test.
I think it was.
But it's that these assumptions only make sense on varying timelines. Like you can assume that over time there's no beating the market, and in a long enough timeline, yeah, sure, that makes sense. But you can't assume that on that same timeline, you can assume that there's no asset bubbles, because you can see on the timeline, yes, there have been.
Yeah.
So it has to be a shorter timeline to assume that there are no asset bubbles. That's what always bugged me is like you're picking and choosing where this works and doesn't work for your assumptions, which again, I feel like this is why I find behavioral finance so fascinating, because there's so many things that go into like just standard financial rules where I'm like, this doesn't make any sense to me, because that's not how people work, because people are chaotic and whatever. Also, I did want to note that we have a question from YouTube I'm going to put up in right here. What if I hate a company and strongly want to short them? Even if I am right, should I avoid the trade outright just due to being too emotional?
So my daughter had a choice between two internships that she really wanted this coming summer, and she kept making arguments back and forth, and I said, "Do the pro con list, man." And I think if you've got a negative attitude toward a company, just from a very high level, you think they've got a bad reputation, they made you mad customer service wise or something like that. You got to try and brush that stuff aside, and really take a look at the fundamentals. Where is it valued? Why? And you're talking about shorting, which I always say is at least 3 times harder than buying stock, because you're going against the you're going against the stream. The stream is always, over the long term, the momentum of stocks is pretty much to the upside. So I would write down logical reasons to short the stock. I would also, if you're thinking about shorting the stock, I would have a level where you say, it's not working, I got to get out.
Yep.
Because
I was just going to say that.
you really hate the company, then you're going to be more stubborn with respect to trying to stick with that position if it's moving against you. And I've been in this situation. I worked in the late 90s. I worked at one of about 6 mutual funds that actually shorted stocks speculatively. So and then a long short hedge fund as well. And we would have situations where we fundamentally knew things were going to go wrong, but it took longer for those things to work out than we thought they would. And a real issue with shorting and shorting successfully is it usually takes some sort of catalyst for the stock to really start to fall apart for you. And timing those catalysts is very, very, very difficult. But as far as just getting the emotions, I personally find writing the reasons down, but then also writing reasons down that I'm taking the position, writing down how I would recognize that it's not working, doing that when you initially put the trade on, that will help you manage the emotions if it's not working for you.
And I'd like to also make a plug for long puts. So a long put is a option contract, which you would buy this put contract, but it pays off if the stock goes down in value. So you have a limited downside, as opposed to if you sell stock short, you have unlimited downside. So that's something else you might want to consider when you're looking at, okay, I really don't like this company. Fundamentally, it doesn't make sense. I believe that there will be a catalyst. You want to then structure your position so that you're not in a position where if the world fell apart, you're losing all your money or losing even more money than you have.
Cool. So yeah, just EMH, one of the questions I usually get in the classroom is, well, why would you use an advisor, et cetera? Well, there are reasons to use advisors. Even if you believe in the efficient market hypothesis and don't think that that a manager could outperform the market on your behalf, they will get you the correct diversification. They should, and I kind of wish I had put appropriate risk level above diversification, because that's the order that they should be doing things for you. But then also there are lots of tax considerations that come into play when you're thinking about taking profits on a stock, et cetera. And a professional manager will help you with that tremendously. The worst thing in the world is getting a big tax surprise at the end of the year because you took too many long-term profits and maybe didn't offset it with losses, et cetera. So then
I'd like to piggyback on that. The advisors, again, for those tax reasons and those insurance products, they will have access to insurance products that you will not be able to necessarily access yourself. And so from that perspective, that's also another reason why using a financial planner can be very successful. And especially if you're looking at closer to retirement and you're in a situation where you're now starting to think about Medicare and Medicaid, or Medicare, just Medicare.
I also wanted to say that from my perspective, as obviously somebody who knows less about finance than both of you, it's also for me good to have an advisor just to on two levels. One, to control for that emotional aspect of things, that part where you become irrational, like having to or running things through another person, I find can help me grab back onto rationality when I've left it somewhere. Um, and then the other thing is just comfort, which sounds so dumb, but like it is for me so much more comfortable when I have an idea and I'm like, oh, so and so, I'm not going to give you guys my advisor's name, but so and so, uh, um, I think I want to do this. And then they have all their charts and everything because they always tend to work for some larger company, and they can pull it up and say, oh, well, this, and this, and yeah, your assumptions or your theories about this position or this investment are correct or they're incorrect. And that always like that allows me to again hold on to that rationality because I have that additional set of eyes, as it were.
And I'd like to comment, particularly for mental health, a lot of people struggle with forms. I don't know if you're one of those people, but as soon as you see a form, you kind of do one of these like, and you don't want to do the form, you don't want to fill it out. And if you're one of those people, it is totally worthwhile to use a financial planner to fill out all those forms and to make sure that you are on track. I don't like forms particularly, so that's one of the reasons why I like to use H&R Block to do my taxes. It gives me peace of comfort, and to your point, Aaron, about comfort of like, I need to live my daily life. I know that this is a struggle for me. This is worth paying up for to make sure that this gets done. Otherwise, if you, again, don't like the forms, what can easily happen is you just simply do nothing, and then you are making a choice by opting out.
So the three forms of efficient markets, and they kind of work their way from the inside out. The information set of past prices is just starting. The publicly available information is everything that we possibly maybe can find with the internet. And then relevance to a stock. And on the next slide, we got a really nice graphic that shows insider trading. The belief is that even insider trading cannot make money off of stocks, which I know for now you might get caught, but trading on inside information has has proved to be profitable for folks that are legal insiders. And what I mean by that, or in doing legal insider trading, is I think we've all probably been subjected to Landman at this point, which I think does a great. I used to cover the energy industry, and it's almost like a masterclass on how those things work. If you follow the insiders that work for the drilling companies in Texas, they sell their stock at the top and they buy their stock back at the bottom, and a lot of them make more of their fortune from trading their own stock legally, because they are allowed to buy and sell their own stock. They just have to they have to share that with the public as they do so. But I've seen too many instances where people are very, very close to a company, maybe work for the company, and not breaking the law, but have been able to profit quite handsomely by by just trading their own stock, for lack of a better way to put it.
Well, and it's funny you should say that. So Russell and I used to commute together from Chicago to Indianapolis twice a week. And so we're on I-65 for several hours every single week together. And one of the things that we began observing was the number of trucks on the expressway. So there would be lulls for trucks out for delivery and times where we would see spikes. And we were postulating that this is also information that could be used as information to determine whether or not more product is being sold. Again, that's not technically insider information, it's just observation of what's happening around us. And so it would be legal. And if you were one of those truck drivers, you would then have even deeper insight And again, just based on the number of times you're being hired to run a particular route. And that could give you deeper insight for whether or not this would be a buying or selling opportunity for that company.
Sorry, just wanted to jump in and go back to one of the most hindering questions that I've been getting throughout this whole conversation is what is something, or what is a foundation to build a good financial health, right? We've gotten so far in terms of like what mental behavior looks like in terms of your day to day and what to feed your mental brain, and then what does that look like for financial health? How does a one person create a good foundation to begin with? Doesn't matter what stages that they are in their life, if that makes sense.
I'd like to jump in on this. So this is obviously going to vary dramatically from person to person. Recommended mental health with your financial health is you have a mortgage payment less than a third of your take-home pay. You have 6 months of emergency savings set up. So if you lost your job, you would have 6 months. I don't know that that's realistic, but those are the types of things that people start to do to make themselves feel emotionally secure about their finances. And again, that's going to differ from some people depending on your risk appetite. Russell, what are your thoughts on this?
Well, I love citing these numbers that are I'm using all of my best stuff from the classroom right now. But there was a study for individual investors, and what they were trying to figure out is how infrequently you should check your retirement statement. And the findings were that if you check it more than once a year, you can fall into a behavioral trap. And where it really even gets worse is you're typically going to, if the market sells off 20% this week, you're going to be checking your retirement. You're going to check it at the absolute worst time. And that leads, that would lead to making suboptimal decisions with respect to your retirement account. So that you can't pay attention too much to the day-to-day swings. I really think the worst thing an individual investor can do is have CNBC on all day.
Well, and
too much being thrown at you.
And Russell, this is somebody that Russell and I both know, Dr. Keith Black. His recommendation was you check your portfolio on your birthday as a birthday treat to yourself.
Well, hopefully.
So there's a question.
Yes.
So, and I wanted to just kind of chime in based on, the great knowledge that you're sharing with all of us today, and also in relation to Robbie's question that you'd answered about how some people, to have financial security, right? And let's say they did lose their job, they have that 6 months worth in their savings to fall back on. But, as professionals in your field, I imagine that people do come to you that don't have that security, they don't have that safety net. What is something that you would say to them, like if they went through a financial hardship and they didn't have anything to fall back on?
So we're not financial planners. So we need to be we come from an asset management background, which is different than financial planners. We quote movies back and forth to each other all the time. There's a movie called The Company Men. And there's some parts of it that are going to seem obnoxious and over the top, but that's one of the reasons why I like this example. It's a situation where Ben Affleck's character is a marketing executive, and the 2008 financial crisis hit. He loses his job. And he starts to hunt for a job. And they, very typical of that time period, did not have any savings. They make a joke how they used their last savings since they went to Disney World. There's a scene where he goes to the golf club and his wife had canceled the membership. And he says, well, what do you mean? She's, we don't have money to eat. You can't play golf. And there's another scene where he's losing his Porsche. You feel for the guy because you could see the deep devastation in his life. And again, if you don't drive a Porsche, it probably sounds obnoxious to you. But for those of you who do drive Porsches, it can be devastating, right? And eventually what happens is he has to move into his parents' house, him and his wife and his 2 children, because they couldn't sell their house, they couldn't get out of it, and he couldn't find a job. He eventually took a job in construction. And Kevin Costner plays his brother-in-law, and he makes a joke about how bad he is at the construction job. But you can see the pain and the anguish, and these are just unfortunate realities. And so I personally think that the best way to get through some of those things is really building that community. Because what if this, and it's a character in a movie, but what if this character didn't have their parents to move into? Right? They didn't have a place to house their children. They didn't have a place to feed or a place where they could get adequate food for their children. Now, it's really a challenging time period for them. And I believe that one of the best things that you could do is really start to build up that community.
And just sitting down and budgeting everything out. They just
Yeah.
seeing, you've got to have a non-emotional, here's where we are. Here's what we've got. I mean, I can recall with my grandfather, my father and his brother, basically taking a look at how long he could stay in his house and doing a budget that, because he was spending a couple thousand more every month than he was taking in just to stay in his house. And they budgeted it out, put it on paper, showed it to him. I almost feel like you've got to sit down with your spouse and just really figure out exactly where the money is coming from, but where it's going and what can you cut. And in this day and age, you probably could cut. There's probably some low-hanging fruit for everyone if you check your subscriptions and all of that kind of stuff. So in a study that we did, we actually found the benefits of Walmart versus Target during recessions because spending patterns change, and that's actually an indicator of recessions is Target's health versus Walmart's health. So you do see that one. Yep.
So Aaron, what did you got for us?
Thanks. So a number of things. We went into a lot of different topics. One, I did want to say we do have a question from a viewer on YouTube that I'm going to put up in a second. But I wanted to comment on both Dr. A, you talking about community, and Dr. Rhodes, you talking about budgeting. One of the things, because a while ago I was a financial advisor, and one of the things that it blew my mind that a lot of my clients didn't do this is that they hadn't written out their budget. They just kind of went, oh, I'm always broke, or whatever. And like doing that is incredibly beneficial, and it also can, for lack of a better word, light a fire under you if you look at it and see the numbers. Because I know I had one client where she was talking about she didn't make enough money at her current job, and she was struggling and everything, and she hadn't budgeted, but like she didn't want to leave her job and all of this. And then we wrote out the budget, and she was losing a lot of money every month. And I was like, okay, well, either you need to cut back on expenses, which it doesn't look like you have too many, or you need to actually pursue getting another job or getting a higher paying job. And it was that writing it out that finally inspired her to be like, okay, I do need to get a better job. On to the community part. That's such a big deal. And I think it's really overlooked how big a deal it is. And I think that for all of the good things that the internet and technology has brought us, I think that it's really eroded community, and in that has eroded mental health for people because you know there are a lot of studies. The stronger your community ties, the easier it is for you to recover from mental health issues, and in general, the better mental health that you have. Um, but like I remember, I grew up in a really rural area. Don't tell my family that because they swear they're the suburbs, even though they live right next to cornfields. Um, but but I remember like everybody was broke. Everybody in the community was broke, and there were a lot of people who didn't get along like at all, but they always showed up for each other, and it wasn't because like, oh, you I like you and I'm going to help you out because I like you and whatever. It was because, hey, this is the community we've built. We're looking out for each other. We're making sure that we're covering each other's bases. And I think that is very true also with finance. Not just with mental health, but with finance, because I have family members who are definitely not doing well financially. And it is painfully obvious, but they won't talk about it. They won't bring people into it. And it gets worse for them. Whereas in my experience, when you say, hey, I'm broke, I'm struggling with money, like just having those people there to comfort you, even if they're not giving you a loan or anything, but
Mhm.
just having them kind of helps you reframe into a different mindset where you can start to get out of it, if that makes any sense.
And I would say that acknowledging what's going on and sharing it with people before it's too late is something I would strongly say. I've just seen a couple of cases of people having a zero bank balance, and that's when they decide to, I've got a couple of issues here. What should I do? Also, I think when you do the budget, you can, if you start to do the budget, you might see that it's not as bad as you think. And odds are, if you've gotten yourself into a bit of a hole, you've been participating in a bit more discretionary spending than you should have. So, and what we consider discretionary varies from people to people. Netflix is discretionary if you don't have a lot of income coming in. So, so there are
So I have
always things
a
that you can
funny,
cut. Yeah.
I have a small funny story. I've recently had to go through my own personal budget, and my sister sent me a Wall Street Journal article that said my kids' sushi habit is making me broke. And then I thought, how many times do I take my kids out for sushi? Oh, this is not a
There you
luxury
go.
for a 5 and 9-year-old. We do not need to be having sushi on a regular basis. And it's again, even my sister just making a joke about it, huge, right? We were able to laugh. We were able to say, okay, this is a silly waste of money. And my kids now are very happy going to the Oasis, the Hinsdale Oasis over the expressway, right? So reframing that mind just to them, but that's probably saved me over $300 a month easy on sushi.
Goodness gracious. All right, we want to hit on semi-strong fund on the next slide forum, because it's a
Ooh,
good. The legal or criminal trader. I apologize. I knew there was one.
yeah, say, Russell, this is
The
all
slide,
you
I'll
because
hit
you
that.
know.
Yeah, I'll hit that question. There's this old thing from the Supreme Court back in the 70s where they talked about they were hearing a pornography case, and one of the judges said, "You know it when you see it." There's something to that with respect to insider trading. The definition is if you come across material non-public information, and material means it would have a dramatic impact by being released on the price of the stock. If you find that information and you find it in a way that it's not, not everybody in the public can find it out, that trading on that would be considered a violation. If I worked at a public company, if Indiana University were a public company, and I told you that our next quarter's earnings were going to be awful, and that wasn't public knowledge, I would actually be guilty of insider trading if you traded on it. So sharing the information counts as well. Now, I'm going to give an example of when I worked for a hedge fund, something that I did that resulted in a really good trade. I would go out to I'm based in Chicago, but I would go out to the West Coast about once a month or so and visit some of the distribution centers that all of the technology from Asia were coming through on the West Coast to reach people in the United States. And they would do investor tours, et cetera. I was on an investor tour and they pointed out that EMC, and this is back in the late 90s, EMC hadn't shipped anything through there in a couple of weeks. Well, EMC's biggest customers were all the burgeoning .com companies and the internet companies. Well, if they'd stop buying stuff, internet's in trouble. Run back to Chicago, and one of the best trades I've done in my career was shorting a basket of internet stocks based on seeing that their spending had suddenly come to a halt. I'm trying to figure out how to see when AI spending comes to a halt to do the same thing. So I'll use that example in class, and there'll be a little bit of a debate as to whether that was inside information or not. They would do investor tours once a month at these distribution centers. Anybody could sign up for them and go to them. It just involved an awful lot of work. But picking up on that piece of information and applying it to a really big trade, we refer to that as the mosaic theory, where you've got a lot of different pieces of information, and all of a sudden a light bulb goes off when you get that last one. And that was kind of what happened with that example. So the legal inside information is where the CEO of a company, files to sell some of their shares to buy a vacation house or put their kid through college or buy a second Porsche because everybody needs one of those. But they do have some insight into their company that we probably don't. But to get around that, they fully share every time they purchase or sell shares.
And it's really difficult to prove insider trading. So this is, it's to Russell's point about, it when you see it, like similar to pornography, right? Because it's ambiguous, it makes it very difficult to prove in court. There's only been, I think, a couple of very famous insider trading cases, like Martha Stewart, for example. And Martha Stewart really got in trouble, not necessarily for insider trading, but because she lied. She was withheld information. This created so much more of an issue than whether or not her broker had moved some shares in her account more quickly than perhaps he should have. But again, it's that lying piece of it, and it's difficult to prove. So Semi-Strong says that you can generate a rate of return if you have insider information. So if we're in a semi-strong form for the efficient market hypothesis, this means that if you have insider information, you should be able to capitalize on it and make a rate of return. That means all equity research, all public information, all stock price, everything else that's out there is already currently embedded into the price, and it's efficiently, those prices in the market are efficiently priced. Our weak form indicates that you can make money based on better equity research and insider information. You can't make money on things like past price movement. And this goes against anybody who's a technical trader who uses past price movement to try to predict the future.
And this, Aaron brought this up a little while ago. The whole, different time frames that some of these things apply to. I know for a fact that people can make money using technical analysis over a very short period of time. In fact, I feel like there was a question somewhere about scalping or something along those lines. Scalping's still done by real people. Yeah, it is. There are people that they typically will do this in some of the very liquid stocks. Like there are people that only trade Apple or only trade, NVIDIA, et cetera. They may trade the options plus the stock, but they are, they're in and out multiple times a day. And now we have options that expire on a handful of stocks every Monday, Wednesday, and Friday. And that is adding to the short-term and scalping activity around those stocks as well. The short-term traders, you can find market anomalies and do well. So.
And I'm showing this book about candlestick charting, which is all about, which is Russell's book.
Yeah.
So, fully believe that there are opportunities in the market to utilize these techniques.
Yeah, and the next slide's a really good example of how you can do that.
Mm-hmm.
So, if a company reports their earnings, and let's just say that everything's 10% better than expected. You might expect the stock to rise, next year's estimate's going to go up by 10%, et cetera. You might expect the stock to rise by about that much. If it was unexpected, what you will see is that overreaction and reversion there, where if maybe a lot of people were expecting, maybe a lot of traders had short positions and company reports their earnings and it ends up being a positive report and they've got to quickly cover that short. That overreaction relative to what the reaction should be, there are a lot of traders that are very active on earnings day and trying to do that. And then the other one, I don't really think we get delayed responses, especially in this day and age, with the amount of information that gets out there and the number of people that can trade on their commute. So I don't know if we get the delayed response where new news is put out and people don't pick up on it. And that's really what they're inferring there. But when news comes out, on a public announcement and it's an announcement that people were anticipating, we know when companies are going to report their earnings. Typically, you can take advantage of the volatility that has a stock maybe overreact to the upside or even overreact to the downside if the news is very negative. And eventually the stock after a short period of time will settle back into something closer to a fair value situation. Anything on over/under reactions before we show how nobody ever outperforms, Larissa?
I'd also like to say, even if it's, slightly out of line with what the market was expecting, if somebody else has bigger news that day, it can be overlooked. So if, for example, I'm trying to think of a non-political news item. Pardon me? So if let's say
it's tough, isn't it?
So let's say Target has like a 5 cents over estimated EPS. Okay, so it's a bump. It's not a huge bump, but it's more than what was expected. But Walmart comes in and says we had 20% growth. The reaction to Target's price surprise announcement should go up, but it's not going to have nearly quite the impact because Walmart came in with such a more dramatic fundamental change.
So on the next slide, so I pulled from the Investment Company Institute. Oh my goodness, that is tough to read. So, just how much money is in mutual funds and, how much is in domestic equity funds, world equity funds, et cetera.
Wait, Russell, I'm going to jump over you for just a second. For our number one fan, what is a mutual fund?
A mutual fund is, it's a financial instrument that's put out by large investment companies that will pool people's money together to target a certain type of strategy. So like this $9.8 trillion in domestic equity in June 2023, or went to 10.1 trillion in July of 2023. That's money that's in mutual funds, not including ETFs, but just mutual funds that focuses on just stocks trading in the U.S. You can see there's a lot less actually in world equity funds, et cetera. So
sorry, quick another for our number one fan. who's investing in these mutual funds, and what types of people are investing in these mutual funds?
It's typically individuals that are in retirement programs that only allow you to put money in mutual funds.
Such
That
as,
such as you know, if you've got a 401k plan at your company, et cetera,
Mhm.
you would you know, you might have one firm that, and you might only have a choice of a couple of dozen mutual funds to allocate your retirement to, which is really a big disservice to you if you're only allowed to be in mutual funds, because the management cost for mutual funds is typically much greater than an exchange traded fund. And exchange traded funds, they trade better now. We have active ones available, et cetera. So for a cheaper management fee, you can actually get the same sort of exposure that you would get from mutual funds. But mutual fund it's probably how a good portion of folks in the United States that have stock exposure get that stock exposure.
Yep.
Yeah. And then we talked a little bit about arbitrage on the net, and arbitrage is one of these things that you know, comes about when maybe one asset is mispriced relative to another one. We teach this and we talk about it. The thing is, it's very difficult to find these to profit on. So why do individual investors need to be aware that that arbitrage has an influence on the markets? Well, any fund that, or any method that would give you direct exposure to the S&P 500, it should be priced in line with the S&P 500. And if the S&P 500 index is at enough of a difference relative to the SPY ETF, there are market participants that might do something with a basket of stocks, such as short the basket of stocks and buy the ETF to bring them back in line with each other. And that constant activity throughout the trading day can really give you assurance that when you buy an ETF on a broad-based index, that you are getting basically direct exposure to that index.
I'm going to jump in. What's also unique about arbitrage, it's more than just mutual funds and ETFs. It is that invisible hand that Adam Smith talks about that forces prices to be in alignment. So if we had, let's say, the Japanese yen is trading on one market and is trading on another market, those prices should be the same. And if they're not, there's going to be a buying opportunity and selling opportunity. Well, enough traders will come in and make this trade to shift supply and demand so that they become equal again. And this forces prices into alignment, which is why we discuss it in our classes. Whether or not individuals or traders are able to actually capture it is not the point. It's the fact that this forces prices to be in alignment with each other, which does to some extent support this efficient market hypothesis, supports the fact that prices are in alignment with each other.
So in starting on the next slide, we actually wanted to get into some, and of course this one's all about Larissa. We wanted to get into some of these things, some of the market anomalies, or some of the things that we do take into account, or get into our minds sometimes. And with the hot hand fallacy, we've seen it in sports. There's a book called The Moment Between Wolf and Dog, or something along those lines. And it is a book about where they actually took they took blood samples from traders midday when they were doing very well and doing very poorly, and looking at what their different levels were on good days and bad days. And what they actually found was people that were really hyped up and having a good morning, and it was showing up physically, typically had really bad afternoons, in a nutshell. So Aaron was trying to break in there, and I kept going, but
No worries. I love this, just like the hot hands fallacy discussion, especially as it pertains to mental health and to psychology, because I think that like we all we all to some extent believe internally in hot hands. Like we believe that if you're
Mhm.
doing well, you're going to continue to do well. And I actually read research the other day that even if you know about it and you've tried to prepare yourself to not have that feeling, you're still going to have that feeling and you're still very likely to act on it. But what I think is so interesting is, there's all this research that's like, oh, it's a fallacy. Hot hands isn't real. And it's based off of sports, but now there's actually research that shows that specifically in sports, it can be real. Um, and the explanation, in my opinion, is flow state, to bring it back to mental health, because like I don't know if any of you have experienced flow state when you're doing a sport or whatever, but like for lack of a better word, your system one thinking is just turbocharged, where you're just able to analyze everything that's going on around you much, much faster. And so you're able to create more opportunities, which occurs a lot in sports because it's a high stress environment where there's a lot of things coming at you all at once. But that's one of the few areas where that actually happens. Um, and so I don't know if I have a question for this, but I just think it's so fascinating that there's so much where we talk about, just because you have been on a winning streak doesn't mean that that streak is going to continue. Each instance is separate. However, conversely to everything else, when you're stressed out, or when you're in a hyper system one state, which is normally what we're trying to avoid, it's actually the opposite, where you can keep winning. And that, sorry, it just blows my mind how, like, in this very specific circumstance, the opposite of everything that we're told is true.
So, this gets back to what Russell was commenting about, where we can actually measure with blood samples, we can measure different hormones that supports what you're saying, Aaron. There's also been studies done where your mental frame will really shape how you perceive an afternoon. There was a study where they took two people and they went to a coffee shop. The one person was in a strong, healthy mental frame. They talked to a neighbor. They were able to get a contact for a new work project. They found, I think, a $20 bill on the floor. They were able, and nothing special truly happened to them, right? They just were in a mental frame. That $20 bill was still, because I reset it up for this other person who was not in a good mental frame. The $20 bill was there. They didn't find it. They didn't talk to anybody around them. They didn't actively participate. They couldn't get past that perspective. And so, to your point of this, your mental health will help you to be able to get to the next level, and so that you can have these successes. What the hot hand fallacy is saying is that you're going to be guaranteed success. So one of the issues that we struggle with, and we see this actually with asset pricing quite a bit, is companies will get overconfident, especially when rates are low. They will begin investing in poor investment decisions. It's called malinvestments. And as a result, we start to make bad decisions because we've had such a huge line of success, and then we feel compelled to do even more risky things. So Michael Jordan's not throwing, I mean, he probably could, but no, he probably couldn't do this, but he's not throwing the basketball from the other end of the basketball court and expecting the ball to go in. He's not taking greater risks during these hot hands, right? He's just really is in the zone and can understand, and he has the right mental frame. The hot hand fallacy really starts to dig deeper in when we've had this series of success. We start to do things that are not in line with what we should be doing. And again, it's that framing.
So it's like contrary, thank you for explaining that. That was really helpful. So it's like contrary to popular belief, a series of successes over a longer period of time can inhibit your ability to analyze
Mhm.
versus just being in a good headspace can increase your ability to analyze.
Right. This is what something I would say with my undergrads. If you like to drink beer, that first one, okay. Second one starts to get a little dicey. By the time you hit the third, you're feeling no pain and you've got this hot hand fallacy, but we all know that they're making bad decisions, right? And it just gets worse and worse and worse as the evening goes on. And again, the more you're being told how great you are going to begin to take bigger and deeper risks. And that can have substantial impacts, particularly when you're thinking about financing or trading.
Uh, are men or women better traders?
Mm,
Let's answer that on the next slide.
I want to answer that one.
I know you do.
Women are better traders.
Yes, they are.
So why do
Very
we think
disappointed I couldn't get my daughters to become traders.
so? Why are women better traders? The answer is going to, I think, be a little surprising. We are less emotional. When a trade is going bad, we get out. When a trade is going good, we collect our profits, whereas men hold on to these much longer, and then we'll end up with losses or not achieving as much return as they could, or end up with bigger losses. There's also a study that working moms are the most efficient employees. And the theoretical framework is because moms don't have the ability to stay late at work, so they must effectively get their job done in the prescribed amount of time that they have to accomplish the job. So these are some of my fun. I enjoy these things.
This gets addressed in that Coates book that I brought up. He actually notes that, and this is my paraphrasing, women are more willing to ask for directions than men.
Mm.
So if you're in a bad trade, it can almost kind of feel like you're lost.
Mhm.
And if you're on a trading desk, you might be willing to ask somebody, quick people that are willing to reach out and go, what do you think I should do here, or get out of their head a bit. That helps an awful lot as well. What does Santa Claus have? I was going to say, what does Santa Claus have to do with trading?
Well, and this goes back to the idea of building a community, right? Women are better at building communities than men are.
Yep.
On average. I'm not saying all men, not saying all women.
Yeah. So, yep.
I did want to chime in from a mental health perspective. I think that's not surprising. One, because Dr. Adamians has already told me this with the same smile she had just a few seconds ago. But
I love it.
also because from a mental health perspective, we tend to think that mental health works best when we can handle it, and like we're handling our mental health or our stress ourselves, and that's the best way to do it. But overwhelmingly, that is not true. And as Dr. Adamians pointed out, in general, women are better at forming communities than men are. And doing things like that, sharing where you're at, confronting your emotions, improves your mental state. And to go back to the last slide, improves your ability to be at a better position to analyze accurately. I think that's just my theory.
All right. Oh, yeah. So Santa Claus, we're going to talk about the
Claus.
Santa Claus rally real quick. We're talking about some market anomalies here. And the Santa Claus, on the next slide, we just have a picture of Santa Claus on the floor. There used to be this belief that the stock market would rise. Everybody thinks that it's over the whole Christmas season, but it's actually just like the last 5 days of the year and the first 2 days of the following year. And if you had consistently bought on the close the sixth day before the end of the year and then gotten out the second day into the new year, that you would outperform on a long term. That doesn't necessarily work the way that it used to. There used to be a bit more tax loss selling at the end of the year and a couple of other anomalies that would get in there. The only area that it works somewhat is small cap stocks now. So that's kind of fallen apart. And then we also have an anomaly known as the weekend effect on the next slide. There are just certain things that happen leading up to a weekend. There are positions that are being taken for a couple of extra days of risk, especially when we're in a geopolitical situation. People, I'm taking it from here to way up here very quickly, but there are ways in the market that you can be long volatility for a short period of time. And I actually found that if you get long volatility Friday afternoons and get out Monday mornings on a consistent basis, you actually do fairly well, because every year we have 2 or 3 weekends that we come in on Monday morning and everybody's very nervous about the markets. So there are some weekend patterns that still exist. They may not be, the types of things that individual traders can take advantage of, but they are definitely out there. So, and then summer trading. Summer trading is just boring. I've worked at proprietary trading firms, and you would hear complaining about the lack of volatility during the summer. What's funny about that is I think like maybe 2 of the last 10 Augusts we've experienced some really excess volatility. So the summer impact that we used to experience where things would slow down, that one's kind of fallen by the wayside. So the next slide, and I'm kind of going quickly through these because I want to get into those academic, the different academic behavioral heuristics. And a big one is mental accounting. And my example on mental accounting is, let's say you go to Las Vegas and you show up at the casino and they got one of those, they say you can have a free spin on some Wheel of Fortune or something, and you win $1,000 right off the bat. If you're prone to mental accounting, you're actually would think, okay, that's the house's money. I'm going to play with the house's money. No, that's your money. But you would treat as a lot of people would treat that money differently, would treat any windfall differently as than they would, from their monthly or bi-monthly paychecks, et cetera. So mental accounting, you may take on excess risk with money that you've made through trading profits, et cetera, versus the money that you actually deposited. Then which was the next one? Herding. We have talked about herding. It's the fear of missing out. It's getting a middle of the night email from a student in China asking me if silver is going to keep going up. That's the herding behavior where everybody's trying to pile into the place that everybody else seems to be making money. Now, what's funny about herding is if you really, one of the ways that you can make money as a speculator is trying to get ahead of that. I had the opportunity to interview Ed Thorpe once, and if you're not familiar with him, he's the one that came up with card counting in Vegas and wrote a book on it. But he also was a very, very well-known option market maker who really introduced technology before everybody else. And he's in his 90s. He's still an active speculator. And I asked him, where are you looking right now in the markets? Like, you get one question offline. I asked him that. And the response wasn't really good for the moment, but it was good for the long term. He said, I'm always looking where other people aren't. And, if you think that the next big trend is going to be biotechnology, but it hasn't started to show up in the markets yet, then you might get into biotech stocks. You might have to wait a little while. But if you think the next thing that's going to be the big story within the markets is a sector that people aren't paying attention to right now, that's a way to profit speculatively from the markets for sure.
And Russell and I talk deeply about these things when we have on our drives, and we've been able to see where the market's going to go, and we've had contrarian opinions to the market. However, some of them are just now coming to fruition, and it's been over 2 years. So just because you can start to see it and you're seeing the herding behavior, these are longer term trading. So for example, Michael Burry, who was mentioned in The Big Short, he was a trader out in California and could see the market crash. He was just a bit early to the game. And so he didn't achieve as much returns as perhaps everybody else. He was successfully fine. So I don't want you to think that there was, he didn't succeed. But again, when you're going against the grain of salt, just similar to shorting, you're in a situation where you have to wait it out for the market to react and to move in the direction that it should. And Russell made the comment, you're usually waiting for a catalyst at that point. Something's going to happen that will change the direction.
And on the next slide, where we talk about self-attribution bias, when I've worked at a couple of proprietary trading firms and I've worked at hedge funds, and I think we've all worked with people who nothing is ever their fault. I did all great analysis on this stock, but the market sold off 20%, et cetera. And what they end up doing is they take all the credit for all the gains. But if they experience a loss, it's completely outside of their control. Or something happened that they couldn't necessarily control. I'll give you a silly example from Billions. They had an inside track, and this was probably insider trading, but they had the inside track on somebody that basically counted chickens for a fictitious market report, and that guy had a heart attack or something, and all of a sudden they took a position of chickens, and this guy wasn't there to count the chickens and let them know what was going on. So all the losses were not their fault because they did everything that they had always done. I thought that was kind of an example of that. Aaron wants to talk to us.
This is probably, to me, like one of the biggest, I guess, psychological principles that just impacts everything, and we really don't think about how it does. And like from a personal story, I've talked on this podcast a number of times about how I've been in therapy pretty much my whole life. And when I was a teenager, like all teenagers, I thought I was the coolest person and knew everything about everything and whatever. And when I was a teenager and in therapy, it did very little for me at the time. And it's because of this, like in hindsight, it was because of this self-attribution bias. Nothing was ever my fault. There was there was nothing for me to learn. There was nothing for me to improve. And nothing got accomplished for me. But then as I get older and I drop this to an extent, I think we all experience it at certain times where we just don't want to confront our failures head on. But as I drop this, there's suddenly all of this opportunity for growth that has been built into me through the therapy that I have. But I think that it's something that financial professionals, clinicians, everyday people, that they struggle with and they should be just incredibly aware of, because it has an outsized impact on the trajectory of your life.
So we had, I wanted to, there was a question. You guys are typically throwing them at me. Jimmy asked, is it true that the stock market was a niche topic from the 20s to the tail end of the 80s and really became popular in the 1990s and beyond? Yeah, that timing is pretty correct. What really started to happen, or the game changer, was in the middle of the 70s. In the Securities Act amendments of 1975, Before May 1st, 1975, brokerage commissions were set on the New York Stock Exchange. And I think if you bought 100 shares, you paid $75. And I don't care what price that stock was. So stocks were things that very wealthy people invested in, et cetera. After that, commissions became negotiable. Firms like Schwab popped up. There were a lot of discount brokerage firms that popped up, and they've all kind of merged into Schwab, Fidelity, and then some niche brokers as well. But that act made it economically viable for individuals to buy and sell stocks on their own. And I feel like you almost, for something to really catch on, you almost have to have a generation. So if you had a generation that suddenly was able to start trading stocks in the mid 70s, by about the mid 90s with the internet boom, that's really when everything started to kick off. But I feel like the deregulation in 75 was the main thing that really democratized the markets. And that's how I like to say it. The markets have become much more democratized.
Yeah, and trades now, you can trade for free at several different brokerage firms. So again, to Russell's point, it's so much easier to get in and out of the market. And when he said that it was $75 to get into the trade, it was also $75 to get out of a trade. So round trip, you're looking at $150 to make a single in and out trade.
I mean, on a $100 stock, that's 1.5%.
Yep, that's huge.
And start going down from there. Anchoring, which we highlight on the next slide. This is another one. This really relates to something we talked about, at the beginning about people and that question we got from YouTube about, how do I make sure I don't fall into behavioral traps? How do the question specifically was, if I hate a company and I'm short it, what should I be thinking about? And if you really dislike a company, that's going to increase that's going to bring in an anchoring bias where you automatically have a bad feeling about a company. If you hear something good about them, you're automatically going to discount it. I hate bringing politics into things, but we're such a divided country right now. I almost feel like, if you hear something good about, one side of the aisle and you're on the other side, you're not going to acknowledge it, and vice versa. You're just anchored to what your party tells you to believe. I think I did that without getting myself in trouble. And then another anchoring bias, and this is one that I'll almost guarantee all 5 of us, because I know I'm guilty of it as well. If I recommended a stock to you right now, the first thing you do is you'd look at the quote. Mm-hmm. That automatically anchors you to a price. Well, Russell recommended it when it's at 35. I looked at it, I did a little work, now it's 40, I shouldn't buy it. Stock Russell recommended was at 35, it went down to 30 instantly. He's just wrong, I'm not going to buy it. Both types of things. Just so an anchoring bias, you've got to try to push that aside and be as objective as you possibly can be when you're taking a look at at a potential investment. And then we wanted to get into Fama French a little bit. And the reason we wanted to get into Fama French is there's a 3-factor model. The other factor that tells you, what factors influence an individual stock's performance. The one that's not on here is the stock market. But then, and this testing was done a while back, there's a belief that the small cap stocks outperform large cap and that value outperforms small cap. And without even talking about it, I want to flip to the next slide, which is the S&P 500 versus the Russell 2000 over the last 20 years. And you can see they both kind of overlapped each other a bit. But when you start to hit about 2020 or so, the S&P 500, which is a large cap index, has strongly outperformed the Russell 2000 and over many time frames going back over the last 30 years or so. You do have an outperformance of the S&P 500 relative to the Russell 2000. even though the Russell 2000 has experienced more volatility. The whole idea in the academic world is if you're taking on more risk, you should receive more returns. That's the idea behind small cap outperformance. It just hasn't held true over the last 20 years. And my theory behind that is that there are companies that you would go through the venture capital process, stage 1, stage 2, stage 3, maybe start to turn a little profit and then go public as a small cap stock and work your way up to being a large cap stock. I think private equity is becoming such a dominant factor in the markets is taking companies that would be successful small caps, keeping them private until they go public as large caps. And because individuals can't get that small cap exposure on the really successful ones that the venture capital firms have picked out, we've seen an underperformance of small cap stocks. Now, I might be completely wrong on that one. It's really just a theory, but I haven't had anybody beat me up on it or discount me on that one yet.
Russell, I have a really quick question for the number one fan. What's the difference between the S&P 500 and the Russell 2000?
The S&P 500 is 500 it's actually 505 of the largest 500 of the largest stocks in the United States. And it's rebalanced, I think, on a quarterly basis now. The Russell 2000 is about the FTSE Russell folks a couple of times a year will take the 3,000 biggest firms in the U.S. and they will take the top third and those go into the Russell 1000, and the bottom 2/3 would be the Russell 2000. So it's small and mid cap stocks. The value of the Russell 2000, all about 2,000 stocks that are in it, is less than NVIDIA.
Okay.
NVIDIA by itself has a smart market cap larger than all the small cap stocks together. And Russell 2000 is considered a benchmark with respect to small cap performance.
And I think Aaron has a question.
Okay.
I did. So I've looked at this before, and how do I say this? It's very troubling to me, because especially as Dr. A, you and I were talking about this earlier, because of the K-shaped economy that we're in. Because to me, and the description that you just gave, what it's saying is that money is concentrating in an extreme way amongst a very select group of entities and individuals, and everything else is either remaining flat or trending down, and that seems like a bad thing. And I think when we talk about like our own economic times, and when we talk about mental health, I feel like people who may be watching this or who may get this information from some other source and they see this, I understand the sense of frustration, in some cases, learned helplessness, and anger that I think we see. You were talking about politics before, that we see in this country, and actually we see it globally. There's been a number of revolutions in the past few years geared entirely around the economy, and to me, this is just me kind of qualifying that statement. To me, it seems like our political woes as a country and as a globe look to be really geared around specifically this graph, where money is concentrating in a very small area and everything else is either flatlining or decreasing. And because people are so much more anxious or frustrated or angry or whatever because of their economic woes, that causes increased polarization, that causes increased political turmoil and things like that. It's just my theory, but I did want to throw it out there because, like I said, to me, this graph is very troubling.
Yeah,
So,
yeah, I think, and it,
so Russell,
Russell,
I'm going to
go ahead.
talk over you.
Yeah.
This is one of Russell's theories, and we have not tested this. We don't know this for sure, but I think that the theory, the logic is spot on. What we have is these very large firms that dominate the market. And prior to the last 20 years, if you had a small firm, smaller firms were able to outperform because there was more room to grow. So now these large firms, as opposed to developing the new technology themselves, so go out and just simply buy that smaller firm. So the larger firm doesn't have to develop the technology. And now we're seeing this gap in the markets of these smaller firms that would have grown beautifully into their own huge company. And as a result, we're seeing these very large companies as conglomerates. And so that even furthers this idea of the K economy, because the top, they're sucking up the best of the best of the upcoming firms, new innovations, the entrepreneurship, and things like that. That's being all sucked up by the large cap. And this is, I do not want to take credit for this idea. This has been Russell's idea, and we've been talking about it for quite some time, because when I was a student, we were always taught that small outperforms large, because when we think of like a company like McDonald's, how can McDonald's grow at 20%? Where are they going to find new customers? Where are they going to find new efficiencies? Where are they going to find new product line to justify a 20% growth? But a mom and pop taco stand, they can easily grow at 20% because all they have to do is offer now enchiladas with it, right? And now we've got new products that are coming in. And so if you're McDonald's, instead of developing that line themselves, what they would do is just simply buy the mom and pop shop. And now that's justifying McDonald's growth, but now you no longer see that mom and pop shop. And so that's also a challenge, because the successful smaller companies are being essentially just acquired by these larger companies.
Absolutely. And so if you think small cap versus large cap is dramatic, on the next slide, look at what value has done versus growth. And remember, Farmer French says value outperforms growth. Now, this is the growth stocks in the S&P 500 and the value stocks in the S&P 500. That's where these two indexes come from. And it's been a long time since value has outperformed. Now, the way that Farmer French defines valuation is based on the price to book, and book can be unreliable. So that in its own right, not many investment analysts outside of maybe looking at the financial industry really use price to book, unless you're looking at a distressed company. So I don't know.
Wait. I'm sorry. I got to jump in. For our number one fan, what is book value?
Book value is basically the firm's, if you take the firm's assets minus their liabilities, you'll get their book value. So it's kind of, if you could liquidate all the assets at what they're worth and pay off all your debts immediately, it's what you would have left over. And I like to describe it to students as, you've got a savings account, you've got a checking account, you've got a credit card. If the credit card balance is higher than those two others, you've got negative book value. Try to say it how I would say it. But yeah, the value versus growth, that belief, following those two Farmer French beliefs, which are still taught in the textbooks, it drives me a little bonkers that I get to talk about them, that I have to explain that they really don't work.
And I want to jump in. So value is the hot topic because of, is it Benjamin Graham and Warren Buffett? It was Graham that was his professor. So they're both looking at investing with growth at a reasonable price, or very GARPy. So this has been the investment philosophy that's been handed down from generation to generation, is we're constantly looking for those cheaper stocks that have the potential for growth. And again, we define cheaper as being on the bottom half of the PE, or the price to book, as defined by Fama French. And historically, those firms that have good financials and good financial health are going to outperform. And that's no longer the case. And so a growth company you pay up for because you have this anticipation that there's going to be higher revenues in the future. And so now you're paying a premium for that. And so let's say it's a technology firm that's well established, and now they're looking to have a higher stock price. They might go out and do some more acquisitions to achieve those growth, and that will simultaneously then boost up their stock price, which then demonstrates an even higher rate of growth, which is why we might be seeing this now.
Can you guys jump to slide 32? It says, "What is behavioral finance?" I just know we're on time, and I want to get to the to the meat of stuff. And basically, we threw this out when we started, and my dissertation is on it. That's why Dr. Ademiak keeps kind of referring to my life with behavioral finance. It's modeling the markets to try to take into account, different psychological effects, and to go back to the Ed Thorpe thing, if you can pick up on people making some of these errors, and we've got information processing ones, we've got some different behavioral ones as well. But like on the next slide, we talk about forecasting errors, and we only have so much time to dedicate. And I used to work with a guy that never, I remember the day after the Super Bowl, somebody called him up and you could tell they said, "What'd you think of the game?" And he goes, "Oh, I don't watch football." And then it started into, just a regular old discussion there. Well, he basically would tell students, when we would bring college students into the CBOE, when I ran education there, he would tell them, or ask them, "How much time do you spend watching ESPN every weekend?" And if there were guys that spend 2 or 3 hours, so like if you spent 2 or 3 hours paying attention to your investments, you'll probably do a lot better over time. And that's kind of an example of having limited time. One of the reasons that Warren Buffett outperformed was he optimized his time. His diversification, it came from only 20 to 25 stocks. Most managers own 100 to 110. So you're more likely to have a forecasting error if you're trying to pay attention to 110 things than 20 things. So I think one of the ways to avoid forecasting errors to understand your investments well enough that if new information is pertinent or not and something you should react to. You really should not be trying to pay attention to more than a couple of dozen stocks. Overconfidence, that we all, I had a PhD professor who liked to say, "Who thinks they're better than the average driver in the room?" And everybody would raise their hand because, we're all arrogant PhD students, but that's not statistically possible. There half of us are not above average smart, and half of us are smarter than the average person. If we have, and that hot hand fallacy really does feed into the overconfidence thing. If you've just been trading up a storm, you've had 3 great months in a row as a proprietary trader, you might want to take a month off, because typically you get very confident, you take on extra risk, you start to overestimate your abilities as well, and that gives you confidence if the market's working against you to maybe stick with a position that you shouldn't be sticking with. Anything on overconfidence, Larissa? Or?
Nope. I think this is what we were kind of talking about with the hot hand fallacy as well.
Yeah, and then also, we might frame that, or we have conservative bias. That a lot of us, especially, we had a whole generation that came before us that either experienced or heard about the 1930s, the 29 crash, and there were lots of people that we got that question about owning stocks becoming much more of a mainstream thing in the 80s and 90s. I think part of that might have to do with us being 2 generations removed from the stock market crash and people's experience with investing in banks. People didn't even trust banks for a very long time. So that conservatism bias can come from past experiences as well.
Aaron, you're up.
So it's actually this one, the conservatism bias, that kind of opened my eyes to behavioral finance. And Dr. A, you were involved in it, and I know I've told you this story, but in one of your classes, we were doing an equity valuation for CDW. And at the time, it was just a mess of a company. It had just gone public after years private, and it was like its third time going public because it kept going private and then public and then private and then public. And every time it did that, it acquired a whole mountain of new debt, and like it was just a mess. But we ran it through, a bunch of different valuation metrics, and we found that it was not just undervalued, but like dramatically undervalued. And I remember the entire class being like, no, it cannot be undervalued. And you telling us you have to rate this at this point as a buy because you're saying it's going to go up dramatically in value. And it took the class so much, including myself, to wrap around this idea that in spite of everything that we thought about it and everything that we had researched before, this was actually a good company to buy. And it really started me down this path of like being so interested in behavioral finance.
And I want to put out a little shout out. This was that team for CDW. So it's still on my desk, Aaron. So we were competing, and we competed against Dr. Rhodes. I think you were with Loyola at the time.
I don't remember, I don't remember doing, I remember CDW, but I don't remember doing that one. I think we didn't field a team that year or something along that. I'm pretty sure we didn't field a team.
Then we definitely beat you then.
You would have beaten me anyway. You're absolutely fantastic at that. When we talk about pattern recognition, we see patterns in things. We see, bunny rabbits in clouds and all of those kinds of things. One of the things that I share in class is a chart that I make with a random number generator, and the chart it like ranges from 1 to 10, and it goes up to about 7 and comes back down 3 times. So you can see a pattern on there, but it's random numbers. So there we go. All right. We can talk about framing and regret avoidance on that. Yeah, framing. Sometimes, how are these choices given to you? You can, present the same mathematical situation in 2 different ways and have people think that one is better than the other. That just based on how things may be presented to you. People are often being very salesy about financial instruments. There's a good chance that the gains aren't going to be quite what they demonstrate to you. And regret avoidance, I always feel like that relates to the conservatism and also relates a bit to overconfidence. As if we were overconfident, and then we get hit, how long are we gonna get till we can dust ourselves off and not worry about the next choice because our last choice happened to be a poor one. So there, and then prospect theory, which is kind of which is on the next slide, and the all-encompassing factor or behavioral bias, where a lot of these things came from. Prospect theory came from a couple of gentlemen, Kahneman and Tversky, that originally came up with the questionnaire, which we all hate, but the questionnaire that decided what you should do for your 2 years in the Israeli army, and put people that were, technology savvy into cyber warfare, et cetera. But they found that, they could get some insight into people's thinking with respect to increasing or decreasing risk, and also increasing and decreasing wealth. Larissa mentioned Michael Jordan being worth billions of dollars. His utility for the next dollar he gains or the next dollar he loses, it's not the same as some of my college students' utility with respect to the next dollar they make and the next dollar they lose. In fact,
I have a quick thing I want to say. Nicholas found a dime on Saturday.
Uh-huh.
It was an
That was
amazing
huge
day
for
for
him.
him. Huge, right? Nicholas is 5. So Nicholas was just like, he's just like, I found a dime. Like, I'm the wealthiest man alive.
So the next slide shows what we think the utility function should look like, as wealth goes. The next one is what Kahneman and Tversky said, and this is really where I want to get, is that on the next slide, the utility function under prospect theory, as you lose money, but notice what happens if you really get hit. It starts to it almost, I feel like that utility becoming less and less negative as, your change in wealth is down 25% versus 5%. It's almost a feeling of hopelessness that occurs, for lack of a better way to put that. And but it happens to the upside, but they also showed that it happened to the downside as well. And that created a whole area of study to talk about how we deal with losses.
Which is why behavioral finance is such an exciting and new topic within finance. And I think it's such an important topic to continue to explore, especially as we're starting to look at the divergence in the economy with the K economy, and how do we support people with their mental health as things start to unshape it with the economic landscape changing.
Yeah, I think as we were going through it, and I'm sorry, we ran out of time entirely because I keep derailing things, which that's
No, this is great. This is a good conversation.
But as we were going through it, I was like, oh, I wish I hadn't derailed so much, because so many of these things play into your day-to-day life. And prospect theory is one of my favorite things to talk about from a mental health perspective, because it explains so well how people can get into a spiral and it just keep getting worse, because at a certain point, every new negative doesn't matter as much as it used to. So who cares? Which is to me one of the things that helps explain things like alcoholism, gambling addiction, any sort of addictive level behavior, where it's like, hey, I'm doing this because at a certain point I lost touch with the negative.
Right.
And sorry, it can also go the other way, of people who have so much and still spend all of their time looking for more, of, hey, I'm doing this because I've lost touch with the positive, if that makes sense. So to me, it's a mental health thing on both ends.
And it's all about the marginal utility you get from that next unit.
Yep. Yeah. Well, we are out of time. This was a great conversation. Thank you so much to Dr. A and Dr. Rhodes for joining us on this. Tons of great information. I'm sorry we didn't get to everything. We'll have to have them back to talk about this and a number of other things regarding finance and economics and mental health, because this was so great. Don't forget to like and subscribe. Check out their site, Academic Market Insights, and their YouTube channel. Great stuff. They get way more into the nitty-gritty of things, and there's a lot to learn. And again, thank you so much, and we'll see you next time. Bye.
Thank you so much.
Thank you for joining. Bye.